Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here today. Gosh, we've got so many good things to talk about. Never enough time. We're going to get right into it. Talk about our tariffs impacting inflation yet. We're talking about that. It's going to be surprising, I think. A lot of people are disappointed. But is the market in a bubble? Well, we're using that term now because things are looking kind of crazy. We'll talk about why we feel that way. And also, too, retail sales show another strong economic data point. Good news there. We'll talk about that. And then also, too, as always, second part of the show, we talk about some companies that maybe you can invest in, look at buy, selling, holding. Chase, what do we got?
Yeah, some great companies here. You know, a company that's really kind of, I'm going to say, blown up after its IPO. We're going to look at Circle Internet Group. Also going to look at Archer-Daniels-Midland, Kenvue, and then SHAK. As always, going to break down those fundamentals for you, giving a opinion on what we think if it's a buy, sell, or hold based off the numbers we see here.
Yeah, and that's always backed by reasoning, backed by the fundamentals of what we talk about, not just like, oh, we think it's great because it's going to be the next Amazon, whatever.
Yeah, no, there's always a reason to why we buy something, which seems like some people have lost that investing philosophy.
Well, when things get frothy, people kind of like, oh, they just throw caution to the wind, but we still keep caution here. So, but let's talk about the tariffs impacting inflation yet. Well, the Consumer Price Index, also known as the CPI, in the month of June showed an annual increase of 2.7%, which was in line with the expectations. Now, core CPI, which excludes food and energy, came in at 2.9% and was also in line with expectations also. It was also slightly above May's reading of 2.8%, but giving all the news around tariffs, well, I got to say, I think most would be surprised to see the limited change in prices given all the concerns we're going through, and we keep waiting and waiting and waiting. We get the news like, oh, no, nothing too bad there.
Yeah, I mean, I definitely am surprised. I mean, I thought we might see something in the threes as these tariffs are coming in, because they're out there. I mean, it's not like they're not happening. I mean, they are now part of the economy, but, you know, I still think maybe it'll be down the road, but we'll have to see what happens.
Didn't we get the lowest number, correct me if I'm wrong, I think it was like 2.4%. Did we get down to 2.4 at one point?
You might be thinking headline. That's very possible. But yeah, I know the core, the lowest we've gotten since, you know, the inflation debacle, I'll call it, a few years ago, has been, I believe, that 2.8% level, which, again, that core level is going to be, I'm going to say, more important to what the Federal Reserve is looking at in terms of cutting rates. The headline, I mean, I was looking at energy. Gasoline was down 8.3% year over year. That's going to go away at some point, and that headline might actually go up even more because you're not getting that large benefit that you're getting from gasoline. So I think it's important to look at headline, but also important to look at cores. I think that is the more important number the Fed will consider.
Yeah, I mean, it's kind of, you got to go look at both because the headline number is important, I think, too, because we do use a lot of food and energy, and I know
it's part of our daily expenses. You can't not look at it.
We tell people they take it out because it's so volatile, and that's why they take it out. But it's still important to look at that headline number as well. But it depends what the Fed looks at, too, because you and I can't move interest rates.
Yeah, I mean, speaking of the Fed, I mean, one thing we talk about is I think some economists, they're still trying to reason with these tariffs. And I got to say that some of them pointed to areas like apparel that had an increase of 0.4% compared to the month of May and said, you see, that's where the tariffs are coming in. And I got to say, my concern with pointing out limited areas like that is prices are going to be volatile in those categories when you're just looking at one specific data point. And also, too, I mean, if you look at apparel prices compared to last June, they actually declined 0.5%. So in my mind, that's a terrible thing to look at. Also, too, the thing I was surprised by is what would you think is one of the most impacted areas from tariffs?
I would say, well, apparel, because I think a lot's imported. Cars, because
Cars.
Yeah.
Cars is what I was thinking. In the month of June, month over month, new vehicles actually declined 0.3%. Year over year was up 0.2%. So I'm pointing that out because I just don't think the tariffs are really working their way through to these prices yet, because vehicles, I think, would be one of the most impacted by the tariffs.
And one thing too, we do bring out, month over month and year over year. And sometimes you'll hear numbers like, oh, see, that's terrible. But it could be just a month over month. But when you look at year over year, that's the reality of what's really going on, what you paid over last year, because things can be volatile, or the previous month you could have a drop. So that's why we like to look at year over year. We do always give you the month over month, but still you got to look at both to get all the information.
No, absolutely.
So, shelter. And we've talked about shelter for years, and it's becoming less of a problem for the report, but it is still the largest reason why inflation remains stubborn, considering the annual increase was above the headline and core numbers at 3.8%. It's so frustrating because we've talked about shelter for the longest time. We don't really like the way that they calculate shelter, how they do it, but it just continues to add to it. And it's based on a calculation of rents or the equivalent rent that people will be paying. It was some weird number. You got the number?
Two categories. Well, it's rent, which if you're paying rent at an apartment, I mean, that feeds into shelter costs. But also the other aspect is owner's equivalent rent, which is you ask people what they think they could rent their house out for. And the issue with that is when we had home prices surge years ago, the shelter component was not going up that much to reflect that. It almost kind of elongated the runway for shelter being a problem in the inflation report, and we're continuing to see it. I did not think it was going to be this long of a runway, but it's still there. I mean, you could have a decline in home prices, and shelter expenses could continue to be elevated like we're seeing.
Well, and the equivalent rent is a real problem because what people think they can get for their rent, they're always going to be high. Everybody always thinks their house is worth much more than everybody else on the block. I mean, that's just something that you're going to come with a high number. I don't like them using that number.
I think it's a terrible thing as well, because not even do you think that your house is many times worth more than it is. Most of the time, you might not even know a neighbor in the neighborhood that's renting a house. So how could you then come up with I think my house is worth $1 million. I think I could get $5. Like, you don't even know what we could get for rent. I think it's just a ludicrous idea. To me, it should almost be something similar to, what we see with food and energy, how we back that out of the headline. Right. I almost think that should almost be similar with home prices, where home prices and rent would be something that are calculated in inflation, but you kind of back it out like you do with food and energy because it's going to be more volatile than what we get with the owner's equivalent rent. But I just think that's a terrible calculation in my
There's
mind.
got to be a better way to do that. I'm just not happy with that one. And we still talk about it because it's there. It is a number we use, but it's just still we look at it a little bit different.
Yeah, and I mean, another thing we look at too is it's going to be the producer price index, and that was something that came out this past week as well. And I thought maybe since we didn't see a large CPI print or a large surprise there, maybe the producers are kind of eating the cost, so to speak. Not looking that way. June PPI showed an increase of 2.3%, which was below the 2.7% reading in May, and actually marked the lowest level since September 2024. And then core PPI, which again excludes food and energy, came in at 2.6% on an annual basis, the smallest gain since July 2024. So producers, consumers haven't seen that price increase just yet.
And it was amazing to me that the producer price index was lower than the CPI because generally you'd think that the producers would add a little bit more to it, and they don't seem to be doing that. They seem to be doing less with the PPI being lower. You got something on that, don't you?
What do producers not have? Owner's equivalent rent at 3.8%. So that 3.8% is not part of that reading.
That's right. So that kind of shows how bad that reading is because of that equivalent rent. Yeah, we should come up with something better on that. But perhaps one thing we continue to discount the U.S. economy is the fact that it is driven by services rather than goods, which could help reduce the burn of tariffs because there's really, I'm going to say this, and I might be corrected here, that there's really no way to put tariffs on services that I can think of.
Yeah, I'm just going to use, I always seem to use my barber as an example.
You like your barber, don't you?
I like my barber. He's a great guy. I've been going to him for, about 6-7 years now. But, him having tariffs, maybe the products that he would be buying, scissors, things like, there's not a lot of products that he would be buying on a regular basis that would be impacted by tariffs. He doesn't use hair products on me, so that's not going to drive higher costs. So his service should not be overly impacted by tariffs. He's not going to need to increase prices by, let's say, 20% to offset tariffs. That's just one example of a service, but there's other service businesses that, again, would have very limited impact. from tariffs. Our business, I mean, I guess you have the volatility of the market from tariffs, but nothing would really have a large impact. Our printer company, they put a tariff fee on us for our printer supplies, but that's such a small part of our business. I mean, there's so many service businesses out there that likely would not have to increase prices to offset tariffs.
And I believe the number is still about 70% of GDP does come from services. I think that number is still,
I mean, it's a huge part of the economy. So maybe that is a reason why we would not see as large of an impact from tariffs as people are thinking.
Yeah.
So, and I want to be clear. I still believe we will see increasing prices from tariffs. I mean, you have them on there. It is going to drive higher prices. There's no way that it doesn't. Prices aren't going to go down from tariffs, in my opinion. But I still don't think it is going to be as bad as some other economists have pointed out. That's it.
That's it. We got nothing else on the impact on inflation the month of June, I guess. Okay, so yeah, I mean tariffs. That's good news for people.
Yeah, I mean, I still think it is something to keep an eye on, but so far, limited impact from tariffs is what I would say.
We had a blank there because it's kind of like you feel like there should be something else, but no, that's it.
That's it.
So, okay, well, let's move on and talk about is the market in a bubble because...
that's it, because inflation, that's it. Nothing really exciting.
Yeah, nothing really exciting, which is good news.
Yeah.
No news is good news. So let's talk about the market in the bubble. Again, we've been hesitant to use that word bubble when describing the current state of the market, but as valuations get more and more and even more stretched, I must say I believe we are now in bubble territory, and there's a lot of things kind of started to back this up here.
Yeah, and I would say before I kind of get into some of the numbers, I believe we talked about this last week a little bit on the show, but it's not even just the stock market. I mean, you talk about the real estate market being expensive. Maybe that one's not in a bubble, but it's by no means inexpensive. You look at the affordability index, it's pricey. You look at cryptocurrencies. I mean, obviously we've talked about that for many years now, and that to us makes no sense. I think there's a lot of similarities between a lot of cryptos out there and the pets.coms from the tech boom and then obviously the subsequent bust. I mean, there's just so many percolating issues out there that frankly makes no sense.
And actually in one of our posts, why the markets are hitting a new high, I think there we put in there too something about art. Art. I mean, there's so many things, and also M&A. I mean, there's so many things that there's these flashing lights out there saying, things don't look good, but yet you watch CNBC or maybe Fox Business and like, oh, there's rah-rah people on there.
Yeah, and I would say too, I mean, we like to read Barron's. I think it's a great publication there. I don't agree with everything they say, obviously, but they do a roundtable, and this is the first time I can remember reading that roundtable, and pretty much every person there was concerned about the froth and the valuation in the market. And it was, again, just another sign of it's hard to find good things to buy for the long term because things have gotten so expensive. But just buying the market in the short term, the momentum, it's carrying things higher. It's like, these guys don't know what they're talking about because, I bought Palantir at the beginning of the year and I'm up so big. And, I bought cryptocurrency. And it's like, good luck. I mean, yeah, you've been right for 7 months, or you mean right for 6-7 years? That's going to be the question.
And that round table, I think there's 7 or 8 managers in there, and they're all experienced managers. They've got a good
different walks aligned, different strategies too. It's not like they're all value investors. I think there's 2 value investors, 3 value investors. There's some fixed income people. There's some growth managers in there. So I mean, you have differing opinions. And it was weird to kind of get that vibe that I got reading it. And I think the reason for this is, obviously valuations. We talk about valuations. Valuations matter long term. But Apollo's chief economist, his name is Torsten Slok, released a graph showing the 12-month forward PE today versus where we were in 2000, other 5-year increments. The forward PE for the market as a whole is higher than it was back in 2000. But Torsten also raised further concerns that valuations for the top 10 companies in the index are now more stretched than during the height of the tech boom.
And these are things that, again, kind of stand out for us. We're kind of sharing them with you. And people say, oh, well, it's different this time. It's different this time. And I'm feeling like this is, and I went through the tech boom, and I was wrong for a long time. You don't know what day that day is going to close. But the thing is, you are now starting to be warned. And you may miss the very top. Maybe things go up another 2, 5, maybe 10%. I don't know.
Maybe 15. I don't know. Yeah.
But when it falls, people get the reaction like, okay, well, it's going to fall. It'll come back. And then before you know it, you're down 15%, 20%, 25%, 30%. then you sell. It's like, gosh, and it's also off of a higher number, so your dollar loss is much bigger than your gain would be.
Well, and the issue, I mean, you bring up the tech boom, and I brought up this point before, but, Alan Greenspan is famous for his irrational exuberance quote.
Yeah.
That occurred in 1996, where he's saying markets were experiencing irrational exuberance. Well, again, 1996. It then went on for 1997, 1998, 1999. It didn't pop until 2000.
Yeah.
So, I mean, he was very early to that. But then the issue is you wrote it out, and then you wrote, I'm going to pick on Cisco. You wrote that to 2000, and 2000, 2001, 2002. You lost 90% of your money. I mean, that is hard. And people are like, oh, 20% pullback. I'd be a buyer. Well, you get a 20% pullback, and it then drops a total of 90%. You would have lost so much money doing that. You have to be so careful buying the dip. And I worry that we could have something reminiscent of that. It's not going to exactly repeat itself. And that's a big thing I think people miss is we always say that history doesn't repeat. It rhymes. It's going to be, I think, similar, but not exact.
Right. And we used to do it at our workshops at 19 things to trading. And what happens is that when you start trading, it goes down. Okay, well, I better sell. And you might sell. And then it goes down, you buy more. And then it goes up. Oh, okay, I'm good. I'll buy more. Then it goes down. I mean, you get in this realm to where after 2 years, you've lost 80% of your money by trying to outsmart the market, and you're not going to do it. And the other problem too, Chase, is that considering these 10 companies now make up nearly 40%
Blows me away.
of the entire index. I can't believe when I saw that. And then making it even worse, looking at just the top 3 companies, which is NVIDIA, Microsoft, and even Apple's still in there. They now account for 20% of the index. So that means 497 companies account for 80%. I mean, it just makes no sense at all with what's going on.
Yeah, I mean, I think it's definitely gotten a lot riskier than people realize. And, I think I may have brought this up last week, but I think it is, again, pertinent to this conversation. But I heard this gentleman on CNBC that said, valuations don't cause bubbles to pop. And while that may be true, if you have, let's say, a forward PE of 30 on the S&P 500, we're not quite there yet, but let's say it was 30. I think once that catalyst comes and that pop occurs, it's going to be a heck of a lot worse than if the pop occurred at a valuation of 20.
Yeah.
So the issue is the larger and larger that balloon inflates, you're right. Maybe there isn't a catalyst that causes that big pop just yet. But again, the larger the inflation, I worry about the larger that pop.
And people say, oh, you just, wet blanket, you don't be part of the party and so forth. And it's like, no, I don't want to be the last guy at the party.
And I just really think people will invest in the S&P 500. And again, congratulations. You've done very well over the last 10, 15, 20 years. But you don't realize that 5-10 years ago, that index was, I'm going to say, a lot safer because it was more diversified. But I don't think a lot of people realize now the risk that they are taking by investing in the S&P 500 because they're looking at prior returns. And we all know that prior returns don't necessarily equate to future success.
And that's the truth. They don't realize that as that goes higher in dollars, a 20% drop is a much higher decrease in dollars than the gain you got when it was $50,000. They just don't get that. And then they panic and their emotions kick in and they do that. So it's you've got to understand. And I don't recommend anybody invest in the S&P 500 anymore. It's just too expensive. Maybe it goes up a little bit higher, but it's just too expensive. I mean, it's just not a great thing in the S&P 500.
No, I think it's, again, a lot riskier than people realize.
Yeah. Well, let's talk about retail sales because that was another strong economic data point. Now, and this can be confusing because we talk about, the market's in a bubble. But then, well, wait a minute. Retail sales are strong economic data point, so maybe we should stay in the market. No. I mean, these are two different things.
The economy and the market can be different.
You got to look at the
because it all comes down to what you pay for something.
Yes.
You can have a really strong company that's just too expensive.
Yep. Even though people remain concerned about a slowdown in the economy, their fears haven't showed up yet in their spending habits. And I've seen that myself when I go shopping. In the month of June, retail sales climbed 3.9%, nearly 4% compared to the previous year.
I mean, I was shocked by that. I mean, especially because people are like, well, prices are higher. And because this doesn't factor in, obviously, higher prices. But again, we saw inflation has remained tamer, I guess, than people may have realized. But then sales are still really strong. It's like if you had inflation of, let's say, 5%, retail sales growth of around 4% wouldn't be that impressive. But having somewhat subdued inflation and 4% growth on retail sales, that's a good pairing, especially when you look at that lower price of gasoline. I talked about how that was down over 8% compared to last year. that caused gas stations to have a large negative weight in the report, as they actually declined 4.4% compared to last June. So if gas stations were excluded from the headline number, retail sales actually grew at an even more impressive percent of 4.6%. I mean, that is good annual growth. Yeah. I was shocked by that.
People out there spending, and strength was broad-based, but I was surprised to see areas like healthcare and personal care stores up 8.3%, and food services and drinking places. This shows people are still going out, up 6.6%. I mean, these are two areas that show me people are still getting out and spending money, which generally would not happen if we had a weak economy or they're concerned about the economy. I mean, you can't get a seat at a restaurant sometimes like, oh, I want a reservation for tomorrow night. Oh, we're booked till next week. It's like, gosh.
And the reason I look at the personal care stores as being a kind of indicator of the economy.
What is personal care? Is that like a CVS?
Like if you go do like makeup and stuff like that. Well, you don't do makeup. But
my
point being
does.
is you're not going to be as concerned about your personal care.
Yeah.
If you're not going out, you're not going to want to look all nice and go out. So, I mean, that's kind of one thing that I was like, interesting. Because this area actually got depressed and hit quite hard during COVID as people stopped going out.
Yeah. So no need to wear a lipstick if you want a mask.
Opposite here. But there are some areas where consumers may be trying to get ahead of tariffs, like motor vehicle and parts dealers, which did see an annual increase of 6.5%. And also furniture and home furnishing stores, which saw an increase of 4.5%. But it's interesting, as it has now been a few months of strong sales in these categories. I mean, I remember this really kind of starting in April and being like, oh, well, maybe people are starting to get ahead of the tariffs. So April, May, June. Now, 3 months of people having accelerated sales in these categories. It's kind of interesting to see that. But on the other side of the coin, it will be interesting to see if there is a slowdown in those categories in the coming months, as there, again, could have been that pull forward in demand with consumers trying to beat those tariffs. But again, it's like, if you were trying to beat the tariffs, wouldn't you gone out in April and bought something?
I would think so. We knew they were coming. And even if that is the case, Chase, spending still looks strong in areas not impacted by the tariffs. So I anticipate the consumer will remain healthy. Given the current state of the consumer, I still believe the economy is in a good spot overall. While I'm not looking for blockbuster growth, I'd be surprised to see anything close to recession given all the recent data. I mean, we seem to be going along, and we keep saying we've got a strong job market. I don't see how you can have a recession with a strong job market because people feel good when out there working, getting that paycheck, and very comfortable with their job.
Yeah, and this kind of goes back to the prior conversation around the pop of the bubble. But I mean, if the economy remains strong, you might not see the bubble pop, but you could see a plateauing of the market for the next, let's say, year or two, where it just doesn't really do much, and then maybe that recession kicks in, and that's when the bubble pops. And I'm not going to try and tell you when it's going to pop because I have no clue. I don't know when it could occur. But again, the valuation on the market is why we're concerned, not because of a potentially weak economy.
And it could just be a slowdown in buying, causes the market to just kind of like slowly drift lower there.
Exactly.
So this information all comes from our newsletter at smartinvesting2000.com. Why are markets hitting new highs? Diet drugs known as GLP-1 are hitting some headwinds. A FICO score is no longer the only game in town. Even though the tariffs, producer prices have seen little increase. China, well, they should not own any farmland, and should interest rates be lower? All on our website, smartinvesting2000.com, smartinvesting2000.com. That's a newsletter we're talking about. It goes every Friday at 5 o'clock. Well, Chase, let's jump right into the companies here. Let's head right over to Circle Internet Group. Their symbol is CRCL in the industry of capital markets. I'm seeing nothing here on institutional owned. I know this is a fairly new company. When this came out? Was it recently?
I believe it IPO'd, let's see, I think it was just a couple months ago. I had it pulled up, but I have a bunch of different tabs pulled up. So, yeah, I know it was just a couple months ago.
Yeah, and I know we'll get some crazy numbers here because this is a hot stock. We thought, well, let's take a look. Maybe we can find something to buy here. PE ratio, nope, over 500 versus the industry at 20.9. Price to sales, 26 versus 3. Price to book value, 68 versus 2.1. And price of cash flow, 153 versus 46.9. Now, the growth, unfortunately, nothing there yet because it's a brand new company. So no growth on earnings, no growth on sales. They do not pay a dividend. Looking at the balance sheet here, we got a current ratio of 1, about the same as the industry at 1.1. Nice to see this new company does not have much debt on the balance sheet, 0.1 debt to equity versus 2.0. Net profit margin, 9.1, not as good as the industry at 14.5. And then return on equity, not very good, 2.4 versus 11.9. Free cash flow is only $282 million, very low, but the industry is a negative $7.2 billion. What do you got, Chase?
Yeah, so current price here for Circle Internet Group, again, their ticker symbol is CRCL. It's $223.78. The 52-week range, this is where it gets crazy. The low, $31, and the high, $298.99. So, I mean, this company did IPO at $31 a share, but the opening price was actually $69. So, you know, if you went to buy it the first day it opened on Wall Street, you would have bought it at $69.31 is, again, their IPO. So just a slightly different number there. Either way, if you would have bought it at, what did I say, 69, congratulations. It's now 223.
Do you hold?
Do you hold? That's the question. The concern is the valuations obviously are just out of control, I'm going to say. You go forward to December 2026, the estimated earnings per share of $1.87 gives you a target sell price actually right around the IPO of $31.04. What's interesting about this company is the stable coins. I mean, that's really what they're known for. They do have the USDC stablecoin and I guess the EURC for euros. And I was surprised about this. The way they make money is it generates nearly all its revenue by earning interest on the reserves backing its stablecoins, particularly in high-yield short-term government securities. In 2024, around 98% of its revenue came from that interest income. So that's how they're making money. The question is, are stablecoins going to be a viable thing going forward? And will the big banks come in and actually take market share?
And you know, I was reading something from Jamie Dimon, the CEO of JP Morgan Chase, and you know, he was talking about, and I think they're going to do some type of stablecoin. Why? Yeah. Because they can make money from it. But he does kind of poo-poo it a little bit, saying, why not? I think he said, why not just do the transaction?
He said, we're going to be involved in both JP Morgan deposit coin and stablecoins to understand it, to be good at it. I think they're real, but I don't know why you'd want to use a stablecoin as opposed to just payment. I mean, the theory is stablecoins should hopefully speed up that payment processing at the end of the day, but I think Diamond's like, I think we can do it faster another way. Yeah. So I guess we'll see if he's right or not. But then other banks like Citigroup and Bank of America said they would also get involved in stablecoins. They even talked about maybe all getting involved together like they did with Zelle. Yep. My concern is how would that impact Circle, as now you're going against some big guys in the room to try and compete against.
And I still say, too, that there's a middleman with those stable coins, and they take a piece of profit. So be careful there. All right, we're going to take a quick break here. When we come back, we got our financial planner, CFP Harrison Johnson, talk about what's the deal with these Trump accounts for kids. He'll talk about that. And then we will finish up with Archer-Daniels-Midland, Kenvue, and SHAK. Stay with us. We'll be back. All righty. Welcome back to Smart Investing Show. This is the financial planning section that we talk about financial planning. And today we're kind of talking about the big, beautiful bill that came out and a part of it. And for that, we have our CFP, Harrison Johnson, here with us. Harrison, thanks for being here. And today we're talking about what's the deal with these Trump accounts for kids, because we're talking a little bit during the break. Kind of crazy sounding.
So, yeah, these Trump accounts or MAGA accounts or whatever you want to call them. I'll start off and say, I'm not really a fan of this because of the way the account works. So to start it off, any child under the age of 18 can open one of these things. Not yet. You can open the accounts, I think, like July of next year. So you can't do anything yet. It'll all be about a year from now. But any child under the age of 18 can open one of these things. But children born 25 through 28, tax year 25 through 2028, can receive or will receive $1,000 in seed money from the Treasury. And there's no income limit to that on the parents. So $1,000 for the kids. On top of that, parents, friends, relatives can contribute up to a combined extra $5,000 a year to these accounts. And here's where I don't really agree with how these accounts are set up. The investment grows tax deferred, which is fine, can be invested in mutual funds and ETFs and things like that. However, the seed money, so that $1,000, when that gets withdrawn, that's taxable at ordinary income rates. Any earnings that occur inside of the account are taxable at ordinary income rates. If parents or anybody contributes extra money, that's not taxable. But ultimately, this kind of functions like a non-deductible traditional IRA. So any money that's put into it, you don't get a deduction for putting money into it as parents. The money grows tax deferred, and then all of the earnings and that seed money is taxable at ordinary income rates. So there's a lot of other options that I think are a whole lot better, like even just a regular brokerage account that's subject to capital gains would potentially be better than this for extra contributions into it.
Now, not that the government would ever do this, but it sounds like they made it sound really good. Like, wow, you're going to get $1,000 if you have more kids, is what they're kind of trying to do here, I think. But when you look at the numbers like you just did, it's really not that great of a deal.
The $1,000 is a good deal, I guess. I mean, $1,000 is $1,000. So that's great.
Great, yeah.
Yeah, it's technically a taxable $1,000.
Right.
You're not paying taxes on it now, but when it's withdrawn, it's taxable. So the $1,000 is the best part of it. But as far as the ability to contribute more money to it, I can't think of a situation where anybody should be contributing more money to this because the account is just not an efficient, growth account.
I just don't understand. I mean, you already have 529 plans. I mean, this is worse than a 529 plan because at 529, if you put the money in, again, you don't get a tax deduction for it here in California. It grows tax-free. And then if you use it for education expenses, well, that distribution is tax-free.
Yeah.
But if you don't use it for education expenses, then it's taxable at ordinary income. It's like, why didn't you just put $1,000 in a 529 plan? We didn't have to create all new accounts. I don't know. I think it's
that would have been better. And with the 529 plans, now you can roll money from a 529 into a Roth IRA. I'm not sure if that can happen with these accounts. I was trying to figure that out, and there's probably going to be some guidance that comes out on what you can do with that money, whether it can be rolled over or converted into an actual retirement account. But right now, the way that it's written in the bill is this functions at age 18 as a type of retirement account, which means if you withdraw money before 59 and a half, so that means these kids will have 6 decades potentially of money growing in here. If you withdraw before age 59 and a half, there's a 10% penalty unless you use it for first-time home purchase or education costs. But even if you use it for those exemption purposes, it's still taxable. Withdrawals are still taxable.
And I really, again, as you said, I would not recommend anybody put money into this because now imagine you have basis in it because you're putting money into it over the next 18 years for your kid. Gosh, talk about complexity in 18 years from now. It's like what's taxable, what's not taxable. If you move it into an IRA, well, how's that going to function? I think we've just created so many problems from these that just didn't need to take place.
And that money would be far better to put into a 529 plan or something else. Why would you?
529, Roth IRA, even like a brokerage account, because Chase and I were talking, since you invest in ETFs or mutual funds or whatever, it's not something that you're going to need to buy and sell. It's kind of like you can't access the money until age 18. So that means the money is going to be in there for 18 years and there's no way to get around that. So what's going to happen is people will put money into this, invest in something, hold that for 18 years, and then decide what they want to do it from it at that point, which means if you're not selling anything, you wouldn't have been realizing any capital gains if you had just put that into a regular brokerage account. The difference then is that brokerage account, when you sell it, would have a capital gain subject to capital gain, lower taxes than this, which is going to be ordinary income. So the original plan that the House passed had ways to access the money where it would have been taxable at capital gain rates for certain things, but that didn't make it all the way into this final bill that was passed into law. So now it's like it's really, there's not a case where this is better than anything else. A 529 would be better, a Roth IRA would be better, a custodial account would be better, a brokerage account for the parents, or really if the parents want to help their kids, in many cases they should be just adding money to their own retirement account so that their kids don't have to take care of them.
I can't wait to see, and hopefully I'll be around in 10, 15, 20 years. I think it's going to be such a nightmare, such a mess, and it just adds more complexity because now you got the 401k, you got the Roth, you got the IRA, you got the 529 plans. Now you got this little thing over here.
I had the Cordurval savings accounts. Those aren't very popular. I know I've seen them from time to time.
Yeah, it's like an education retirement account. Yeah.
It's just overly complex, I think, for no reason. And I mean, Harris and I were talking, the only thing we can think of is them adding this extra layer of taxation is like, well, they give you $1,000, but they guarantee themselves essentially of getting money back in taxes. Revenue.
So yeah.
But it's in 18 years.
Yeah. So it's funny because, there's a cost to this because if every child born between, this calendar year and through 2028 receives it, the Treasury has to dole out that money, but then, they're going to get that back and taxes on the earnings. So I don't know what the actual cost of this is going to be. But again, any parents or family members, don't add money to this thing.
Yeah, I just got to make sure I have maybe 2 more kids within the next 3 years.
Yeah. I mean, the $1,000, you're right, is nice. It's $1,000, but it's just like it just kind of empty after that, I'll say.
Yeah, unfortunately. The intention was good. Again, the original House plan had capital gain taxes built into it, but now it's just like a non-qualified annuity or an IRA that you make after-tax contributions to that grows tax deferred, and nobody should ever contribute to those types of accounts unless you're doing like a backdoor Roth contribution or something.
Yeah. Not great news there, but again, that's what
you get $1,000. It's taxable, but you get $1,000.
That's the bottom line. Yeah. So, and that's what I want to do is want to give you the true information, because you're going to hear a lot of stuff probably about this, this is great and so forth. You dig in the numbers,
Don't do it.
Yeah, don't do it.
well, take the $1,000.
$1,000,
But that's it.
yeah.
Don't add to it. Don't do anything else. Do something else. Roth IRA, something else. So cool. Harrison, thank you very much. Great information.
Right. Thanks, guys.
All right. Okay. Well, let's talk about 3 other companies here that we're looking at that were in the news or something maybe could be good investments. And we're going to kick off the company analysis here with Archer-Daniels-Midland. And I've made good money out of this company over the years. I kind of liked it. It's a food type company. They're in farm products, which I like the farming industry, and their symbol's ADM. Short is only 3%, 84% institutional owned. Well, it's kind of disappointing. The PE ratio is now 19.2 versus 4.5. It always had such a low PE ratio, which I liked it, but that has changed. Price of sales, 0.3 versus 0.4. Price of book value, 1.2, same as the industry. Price to cash flow is 15.1 versus 9.3, and the PEG ratio 1 versus not material for the industry. So not the great valuation it used to be at. And here's maybe why. This is even worse. I mean, earnings per share over the last year are down 43%. The industry was up 9.8%. Sales for Archer-Daniels-Midland were down 5.5%. Industry was down 16%, so that's a positive. And for some reason here, the 5-year earnings per share growth estimate from the analysts, they're looking for 13.9% for Archer-Daniels-Midland versus that 1.9% decline. They do pay a nice dividend, 3.8%, use 70% of the earnings to pay that out. And then look at the balance sheet here. We got a current ratio of 1.4 versus 2.4. I'm okay with that. Debt to equity, not bad, 0.6. That's the same as the industry. Net profit margin is only 1.6 for Archer-Daniels-Midland versus 2.7 for the industry. And return on equity, not very good, 6.2. Free cash flow, okay, $222 million versus $338 million. Nothing's really exciting me here. Chase, you got anything to get me excited about? Maybe investing in Archer-Daniels-Midland.
Yeah, so I'll give you the numbers here first, and we'll talk about the story behind what's going on with this business. But current price for Archer-Daniels-Midland, again, their ticker symbol ADM, it's $54.39. 52-week range, the low, $40.98. So I'm kind of surprised it's off that low, pretty substantially. And the 52-week high here, $64.92. Zero last year, the stock is still down about 16%. Year to date, it's doing okay, about in line with the market, actually, of about 7.6%. Going forward, though, we go out to December 2026, see estimated earnings per share here of $4.53, gives us a target sell price of $75.20. So, it's still trading under a 12 times forward PE multiple, which I'd say is nice to see. The issue here, the stock initially fell this week, but then it kind of rebounded because President Trump came out and said that he's been speaking to Coca-Cola about using real cane sugar and Coke in the United States, and they have agreed to do so. Reason that impacts Archer-Daniels-Midland is they produce high fructose corn syrup. And I was looking at this, I was kind of surprised, and this is what ChatGPT told me, so we'll see how accurate that is, I guess. But ChatGPT said high fructose corn syrup made up around 10% of ADM's Archer-Daniels-Midland's revenues for several years, and it said currently it accounts for about 6 to 7% of projected earnings. So that's
a big part.
That's a decent amount,
Yeah.
and obviously Coca-Cola, they're not going to use high fructose corn syrup. That could be problematic. Also, too, PepsiCo, they reported some earnings this past week and said that 60% of the company's U.S. beverages don't have corn syrup. That still means 40% do. If they start peeling away from high fructose corn syrup, that could be another issue as well.
And I guess cane sugar is what more healthier than this fructose.
Just natural. It's not chemically created.
And I do remember going to Hawaii many, many years ago. They had all the fields filled with the cane sugar and so forth. They're completely bare. They don't even do that any longer.
Yeah, I mean, that's the issue is the imports. Yeah. I mean, we don't really produce cane sugar here. So you'd have an issue going to get that overseas in other countries. And it's kind of interesting, actually, the Corn Refiners Association, I mean, obviously they issued a statement not being happy with it because they said it'd come with a high cost. It would cost thousands of American food manufacturing jobs, depress farm income, and boost imports again of foreign sugar. They say all with no nutritional benefit. I think that last piece could be debated. I'm not a health expert, but I know there are people that say there are problems with high fructose corn syrup, but they say not. So, I mean, it'll be interesting to see. But the other thing that I would say outside of the high fructose corn syrup is, the removal of these dyes, the removal of, kind of other food ingredients that are maybe chemically produced. Does Archer-Daniels-Midland do other ingredients that are potentially at risk of this MAHA or Make America Healthy Again movement that has been kind of produced by Trump and RFK Jr.?
I know years ago, 10, 15 years ago, Archer-Daniels-Midland seemed to be a little more simple of a company. They had a lot of corn they grew. It just seemed a simple company. Now it seems like it got more complex, like many things. Makes it hard to understand. Is it a good investment or not? What's going to happen going forward? I do see the last 9 days, the earnings per share for December 2026 are down from 470 to 453. So probably what you were talking about there. I'm disappointed. I really want to say yes, let's buy Archer-Daniels-Midland, but I just can't say that.
Yeah, I mean, you kind of look at stuff just in their summary, and it's it sounds pretty basic. Engaged in the procurement, transportation, storage, processing, and merchandising of agricultural commodities. Sounds pretty basic. Then you start kind of reading other things, and it's like, in addition, the company offers soybean, meal and oil, vegetable and salad oils, and protein meals, ingredients for the food, feed and energy and industrial customers, margin shortening, and other food products. And the list just kind of keeps going on and on. It's like, further provides peanuts, peanut-derived ingredients, and cotton cellulose pulp, sweeteners, corn and wheat starches, syrup, glucose, wheat flour, and dextrose. I mean, it's just a bunch of different things where maybe it used to be a basic agricultural commodity company. Now it's kind of expanded into maybe creating more of those byproducts of agricultural commodities rather than just kind of producing the agricultural commodities alone.
Yeah, I think a lot of companies and trying to grow their sales and earnings have actually diversified into other businesses, other types of products, and it makes it confusing for the investor because it's just so hard. And we like things simple, so you can understand what you have. Again, Archer-Daniels-Midland is not the safe, easy to understand company it was some years ago.
Yeah, I was a little disappointed. I mean, I think there would be some interest in an Archer-Daniels-Midland, but at 12 times earnings, I would want to see this probably drop below 10 times future earnings to actually have more comfort with it, because I think there's a lot of risk to it at 12 times future earnings. I don't think that risk to reward is quite there yet.
And I think they had a big boost like a year ago. Do you have a graph pulled up on it? I think it was like...
Well, they bottomed. They also had issues with accounting, and I think that was either at the beginning of this year or last year, and they had some issues with their financial statements, and it seems like they got through that, and maybe it was just a short-term blip. Maybe somebody forgot to do their job or something, because it didn't seem like there was actually any underlying problems with the accounting of the company, but obviously that's another concern you got to keep in the back of your mind.
Well, let's move on to another household and personal products company called Kenvue. I wonder where this name came from. It sounds like a Kleenex, but it's Kenvue. I'm not. Ever hear what it means? I don't think it means anything. I don't know.
No, I don't think it's like Kleenex or anything. I don't think there's a use case for Kenvue.
Well, Kenvue is a company. That's their name. Their symbol is KVUE. They are in the household and personal products industry. Only 2.2% short on it. We do see the PE ratio doggone it, like 39.3. Well, we talked about the bubble. We may not be able to find many things here, but the PE ratio for Kenvue is 39.3 versus 26.9. Price to sales 2.8 versus 2.7. Price to book value is better, 4.2 versus 5, but price to cash flow is also more expensive than the industry at 22.2 versus 17.4. And the PEG ratio, no deal here, 17.8 versus 22.3. PEG ratios, we generally like them around 2 to 4, probably at the max there. We do see that their earnings are down last year 1.8%, but the industry only up 0.3%. Sales are down 1.1%. Industry was down 0.5%. 5-year earnings per share growth estimate from the analyst 1.1%. The industry is at 4.5%, so nothing really great there. They do pay a decent dividend. 3.7% is their dividend, but they use 145% of the earnings to pay that out. So that's a little bit concerning. And even free cash flow, they use 108.8%. The balance sheet, you got current ratio 0.9 versus 1 for the industry. I'll say that's okay. Debt to equity is 0.9 also versus 3.6, so that is a positive. They do have a lot of intangible assets, 67.5% versus 41.1% for the industry. And we see net profit margin, not that great, 6.9 versus 10.2. Return on equity also some concern here as well, 10.5 versus 25.5. Free cash flow, $1.4 billion. That does pale in comparison to the industry. Free cash flow was $7.7 billion. Just not finding anything great here. What do you got going for it, Chase?
So current price here for Kenvue, again, their ticker symbol KVUE. Well, it's $22. 52-week range, the low here, $17.85, the high, $25.17. And while you may not recognize Kenvue, I'm sure you recognize some other products. And they were spun off from Johnson & Johnson actually in 2023 is when that was completed. But their products include Tylenol, Motrin, also too they have Benadryl. They then have Neutrogena, Aveeno, Lubriderm, all kind of the personal skin health brands. And then lastly, this one I always like to see, Band-Aid.
Band-Aid.
There's one that you talk about. Kleenex, Band-Aid.
Band-Aid. And Band-Aids have gotten so much better over the years. I mean, they blend nice. They hold up underwater. They're just, Band-Aids have had a big improvement.
Well, it's funny because it's like there's other Band-Aid brands out there too, outside of just Band-Aid, but it's like you call them Band-Aids even if they're not made by Band-Aid. You know, so I don't know if you're using Band-Aid branded bands or
using Band-Aid fake brands. I don't know.
Who knows? But also they have Listerine is another one. So I mean they have these well-known products.
I use that product too.
Yeah. Going forward though, I mean this is kind of the issue that we talk about with a lot of stocks out there, but valuation does remain a concern. I mean go out to December 2026, estimated earnings per share here $1.21. Gives a target sell price at $20.09. So, I mean, it's more than what I would consider fairly valued at this point. I was a little bit optimistic here because I saw this past week the CEO was stepping down and it said the board is actually conducting a strategic review of the company and considering a range of possible alternatives such as simplifying the company's portfolio. Generally, I look at that as a buying opportunity because that's like, well, things are going poorly. We need to really focus on the company, get rid of non-performing assets. It can be we've made money off of buying companies in similar situations, but generally you get those companies when they're trading around 10, 12 times earnings, not 18, 19 times earnings.
That's much higher than 18, 19.
Well, no, the future earnings are 18.
Earnings. Yeah, okay.
So I would just say, unfortunately, you know, the idea of why I wanted to look at it was, again, because I read that news and I was like, oh, maybe we could find something here on sale and they could do a, you know, kind of right size the company, fixate on good producing assets, but just not worth the risk at 18 times those future earnings at this point.
And this is the hard part for an investor. And that's probably why so many people are buying technology, because technology has the big growth, even though you're paying a lot up for the valuations. Well, here you got a company that, you know, again, household and personal products, you know, Band-Aids, Listerine. You don't expect to pay such a high price for it, but it is at that level. And you shouldn't pay that high price for it because I think it'll regret it down the road.
Yeah, I mean, the theory is obviously it's consumer defensive where you shouldn't have a huge decline in earnings. There should be a lot more stability there. So sometimes people will pay up for that. But, you know, we don't like to pay up for anything. So no. I wouldn't buy it here because let's say it's around 20 times future earnings and you're getting 7% or I'm going to say 5% long-term earnings growth. That really means you only make 5% a year. Yeah. You know, I mean, it just, I don't think it's worth it at this valuation.
And we like to buy things on sale, and I think everybody does. I mean, you like to buy things on sale. You go in, you get a great deal on something, like, yeah, I got a great deal on this, I got it on sale. Who goes around and brags like, yeah, I paid 20% more for this product than it's worth? I mean, I don't know why people overpay for equities, because generally you get burned on them down the road when you pay too much. People might say, oh, I can get out before that happens. Not really. Speaking of that, let's move on to Shake Shack. I'm trying to think about. I think I ate there once. Have you eaten there?
It's been a while. I honestly was not a fan.
It was okay.
It was okay. I thought it was overpriced. I think In-N-Out is far better than Shake Shack in terms of the value you get for what you're getting. I mean, gosh, I went to In-N-Out a couple weeks ago, and you go and, for my wife, her sister, myself, I think the bill is like $25.
Yeah.
And I got 2 cheeseburgers or 2 double doubles at that point. And I was like, man, and it's so good too. At Shake Shack, I remember going and I was comparing against In-N-Out. I was like, if I'm going to go get a burger, I'm not going to go to Shake Shack. I'm going to go to In-N-Out.
Yeah, it's just, and again, I think you're right. I think that much more costly to Shake Shack, and I think you get more grease is what you seem to get.
Maybe, yeah. I don't remember because I haven't had a Shake Shack burger, I think it's been like 5 years, 6 years.
It's been a while for myself, but maybe we should go back and try it out. But I'll say the shorts agree with us. And again, we're talking about Shake Shack. Their symbol is SHAK. I think the shorts agree with us because there's 20.2% short on this. That's pretty high. We get above 8 to 10%. We get like, a little bit nervous. 20.2 is the short percent on the float on this stock. That's pretty high. We do see, PE ratio 475.9 versus 31.5. Price to sales also expensive, 4.7 versus 2.5. Price to book value actually looks better in the industry at 11.5. The industry does check in at 19. Price to cash flow is expensive, though, 34.8, double the industry at 17.6. PEG ratio looks good, 4.5 versus 19.4. Now, here's a major problem, Chase. Their earnings of last year, down 54%. That's huge. The whole industry is down 4.1%, but I know a lot of companies like Jack in the Box, Wendy's, they're having trouble. And I think they're really getting hurt. Everybody in this industry is getting hurt. And there's a lot of players. You got Shake Shack. You got Gourmet Burger. I mean, you got all these burger places now. There's so many of them. And
Gourmet Burger. Robin?
Huh?
Who's Gourmet Burger?
Some.
Well, there's Five Guys. There's there's the other one. The Habit.
Habit
there's
Burger, maybe.
There's I think those are the big ones. Obviously, In-N-Out's the one I mentioned. But
I mean, they're just all over the place, and it's just like it's hard to compete because there's no moat at all. And I like a good cheeseburger, but again, it's just maybe there is no Gourmet Burger. I think there is.
Maybe you're probably right.
I think there is, but I don't know. But anyways, I mean, their earnings are down 54%. They could be cutting prices, maybe trying to compete. Sales were up 9.7% versus 4.9. The 5-year growth rate from the analysts, this I find hard to believe, 21.8 versus 6.9.
It's coming off such a low earnings base. If you're down 51%, you're making up those earnings.
Yeah, it could be, but what are they going to do to turn that around with all that competition? They do not pay a dividend. We like companies that pay dividends, so no dividend there. The balance sheet to 1.9 is the current ratio versus 1.1. That is a positive, but debt to equity is 1.7 versus 1. That is not a positive. We do see that they have a net profit margin of only 1 versus 8.1. That's not very good. That's a very low profit margin. Return on equity is only 2.6. Return on invested capital, 1.1. You're just not having the value here. Free cash flow, $40 million versus $2.8 billion for the industry. I'm just not excited about Shake Shack, and I can't wait to hear your numbers and what you've got over there.
Yeah, and when I was looking at this, I hadn't looked at Shake Shack in quite a while, and I'm like, it's been around now for 10 years. So I was like, maybe the business has kind of matured a little bit. Maybe the hype has fizzled. That does not appear to be the case. I mean, current price for Shake Shack, $134.86. 52-week range, the low is $72.93, and the high $144.65. 10-year return, it's done pretty well, up 138.6%.
Has it been around for 10 years?
Yeah, it went. Looks like it went public back in July of 2015.
Wow.
Yeah.
Okay.
Going forward, though, for the company, we go out to, I think it's December. Yes, it is December 2026. Estimated earnings per share here, $1.69. Gives you a target sell price, just laughable here, $28.05. Forward PE 80 times. I mean, just so expensive. And the reason I looked at this, Jefferies downgraded it because the firm believes shares are baking in too much optimism around near-term sales. I couldn't agree more.
Yeah, and I think a lot of times the hype continues. And again, I can't believe it's been out for 10 years. But
and not even just the restaurant, but public for 10 years. I don't know how long the restaurant's been around.
And they could be expanding, but the earnings just aren't there. And it's just not, it doesn't excite me. I mean, and I've seen I'd rather buy a Jack in the Box, which I think we talked about them a few weeks ago. But, I want to be in this industry because I think it's a good industry. But as we talk about, it's just too darn expensive to get into these companies.
No, I'd rather buy like a Kava, which also trades at ridiculously high valuations, but at least I think it's different. It's the fast casual Mediterranean where I think Shake Shack just has a lot more competition. I'd be careful.
Yeah, exactly. That's a good way to close. Be careful. All right. Thanks for listening to Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. A lot of great information there. Sign up for the newsletter, again, at smartinvesting2000.com. Thanks for listening. We'll be back next week right here on the Smart Investing Show.